The $1 Rule by Warren Buffett. The world's greatest investor follows a rule so simple. A child could understand it, a rule that turned a $10,000 investment into $50 million. A rule that separates those who build wealth from those who merely dream about it. Warren Buffett, worth over $100 billion, attributes much of his success to what he calls the most important investment principle. It's not about stock picking, it's not about market timing, it's about something far more fundamental. This single rule has guided every major decision in his 70-year investing career, and by the end of this video, you'll understand exactly how to apply it to your own financial future. Warren Buffett didn't become one of the wealthiest people on earth by following conventional wisdom. While others chased the next hot stock or tried to predict market movements, Buffett built his fortune on a foundation of unshakable principles. Today, we're diving deep into what Buffett calls his $1 rule, though it's more accurately known as his dollar-for-dollar value principle. This concept has been the cornerstone of his investment philosophy at Berkshire Hathaway, guiding decisions worth hundreds of billions of dollars. You are going to discover the psychological foundations behind this rule, how Buffett applies it in real-world scenarios, the mathematical reasoning that makes it so powerful, and most importantly, how you can implement it in your own investment decisions, whether you're managing $1, $000, or $1 million. We'll explore actual case studies from Buffett's portfolio, examine the companies he's purchased using this principle, and reveal the common mistakes investors make when they ignore this fundamental rule. By understanding this concept, you'll gain insight into how Buffett thinks about value, risk, and long-term wealth creation. Let's begin. The core principle. Understanding the $1 rule. Warren Buffett's $1 rule is elegantly simple. He will only invest in a company if he believes he's getting more than $1 of value for every dollar he spends. But here's what makes this profound. Buffett doesn't measure value by what the market says a stock is worth today. He measures it by what the company's future cash flows will actually be worth, discounted to present value. Think about it this way. If you could buy a machine that reliably produced $100 per year for the next 20 years, what would you pay for it? Most people might say $2,000, the total output. But Buffett thinks differently. He calculates the present value of those future cash flows, accounting for the time value of money and risk factors. This is where intrinsic value comes in. Buffett defines intrinsic value as the discounted value of the cash that can be taken out of a business during its remaining life. If a company's intrinsic value is $100 million, but the market is selling it for $60 million, Buffett sees a $40 million margin of safety, and that's when he strikes. The genius lies in the discipline. Buffett has walked away from thousands of investment opportunities because they didn't meet this standard. During the dot-com bubble, while others were making fortunes on internet stocks, Buffett refused to participate. Why? Because he couldn't identify intrinsic value that exceeded the price being asked. The market called him outdated. Then the bubble burst and Buffett's principle was vindicated. This rule forces you to think like a business owner, not a stock trader. You're not buying a ticker symbol that might go up. You're buying a piece of a real business that generates real cash. The mathematical foundation. Let's break down the mathematics that underpin this principle, because understanding the numbers reveals why this rule is so powerful. Buffett uses a concept called discounted cash flow analysis. Here's how it works. If a company generates $10 million in free cash flow annually, and you expect that to continue for 10 years, you can't simply multiply $10 million by 10 and call it $100 million in value. Money today is worth more than money tomorrow. This is the time value of money. If you have $10 million today, you could invest it and earn returns. So $10 million received 5 years from now is worth less in today's dollars. Buffett applies a discount rate, typically around 9 to 10%, to calculate present value. Using this method, that stream of $10 million annual payments isn't worth $100 million today, it's worth approximately $64 million. But here's the critical part. Buffett adds another layer of conservatism. He only invests when he can buy that $64 million in value for significantly less, say $40 million. This 38% discount represents his margin of safety. This margin of safety protects against 3 types of risk: calculation errors in estimating future cash flows, unexpected changes in the business environment, and market volatility that might force him to sell at an inopportune time. The mathematics are rigorous, but the principle is simple: pay significantly less than what something is truly worth. This creates asymmetric returns. Your downside is limited by the discount you received, while your upside is substantial when the market eventually recognizes the true value. Real-world application: Coca-Cola. The best way to understand Buffett's $1 rule in action is to examine one of his most famous investments, Coca-Cola. In 1988, Buffett began purchasing Coca-Cola stock. The total cost of his position was $1.3 billion. At the time, many questioned the move. Coca-Cola was already a mature, well-known company. Where was the opportunity? But Buffett saw something different. He calculated Coca-Cola's intrinsic value based on several factors: the company's global brand power, which created pricing power, its distribution network spanning over 200 countries, its ability to generate consistent free cash flow, and its track record of increasing earnings year after year. Buffett estimated that Coca-Cola's intrinsic value was substantially higher than its market price. He saw a company that could raise prices regularly, expand internationally, and generate returns on invested capital exceeding 30%. The numbers proved him right. That $1.3 billion investment has generated over $7 billion in dividends alone over the past 35 years, not including the stock appreciation. The position is now worth approximately $25 billion. But here's what's crucial. Buffett didn't buy Coca-Cola because he thought the stock would go up. He bought it because he calculated that each dollar he invested was purchasing more than $1 of intrinsic value. The market price eventually recognized what Buffett saw immediately. This investment demonstrates another key aspect of the $1 rule: patience. Buffett held Coca-Cola through multiple market downturns, including the 2008 financial crisis when the stock fell 40%. Why didn't he sell? Because the intrinsic value, the actual business fundamentals, hadn't changed. The market's temporary opinion was irrelevant to the underlying value of the enterprise. The psychology behind value investing. Understanding the $1 rule requires understanding human psychology, because this principle goes against every instinct most investors have. Human beings are hardwired for certain behaviors that destroy investment returns. We feel the pain of losses twice as strongly as the pleasure of gains. We seek confirmation of our existing beliefs. We follow the crowd because it feels safer. We act on emotions rather than analysis. Buffett's $1 rule is a psychological defense mechanism against these tendencies. Consider what happens during a market crash. Prices plummet 30%, 40%, even 50%. Every instinct tells you to sell, to protect what's left. The financial media amplifies the fear. Your friends are getting out of the market. The psychological pressure is immense. But if you understand intrinsic value, you see something different. If you calculated that a business was worth $100 per share, and now the market is selling it for $50, the rational response isn't fear, it's excitement. The gap between price and value has widened. Your margin of safety has increased. This is why Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." The $1 rule provides the rational framework to act on this wisdom. During the 2008 financial crisis, while most investors were panicking, Buffett invested $15.5 billion in companies including Goldman Sachs, General Electric, and Bank of America. He wasn't being brave or contrarian for its own sake, he was simply calculating that he could buy dollars of intrinsic value for 50 cents of price. The rule also protects against the opposite problem: euphoria. During market bubbles, when everyone is making money and prices seem to only go up, the $1 rule keeps you disciplined. If you can't identify intrinsic value that exceeds the asking price, you don't invest, no matter how much FOMO you feel. This is mental toughness codified into a mathematical principle: how Buffett calculates intrinsic value. Let's get practical. How exactly does Buffett determine whether he's getting more than $1 of value for each dollar invested? First, he focuses exclusively on businesses he can understand. Buffett calls this his circle of competence. If he can't predict with reasonable confidence what a business will look like in 10 years, he won't invest. This immediately eliminates industries with rapid technological change or uncertain regulatory futures. Second, he looks for durable competitive advantages. What he calls moats. These are structural features that protect a business from competition. Strong brands that allow premium pricing, network effects, where value increases with each additional user, high switching costs that lock in customers, or cost advantages through scale. Third, he examines management quality. Does the leadership team allocate capital intelligently? Do they communicate honestly with shareholders? Are they focused on long-term value creation rather than short-term stock price manipulation? Fourth, and most importantly, he analyzes the numbers. Buffett looks at return on invested capital, free cash flow generation, debt levels, profit margins, and earnings consistency. He's looking for businesses that generate high returns without requiring substantial reinvestment. Here's a simplified version of his calculation method. Start with the company's current free cash flow, the actual cash the business generates after all expenses and necessary reinvestments. Project that cash flow forward based on reasonable growth assumptions. Apply a discount rate to convert those future cash flows to present value. Sum up all the present values to get total intrinsic value. If the market price is substantially below that intrinsic value calculation, Buffett has found an opportunity. Let's use a hypothetical example. Imagine a company generating $500 million in annual free cash flow. You project 5% annual growth for the next 10 years, then 3% perpetual growth after that. Using a 9% discount rate, the present value of all future cash flows might total $8 billion. If the market is selling the entire company for $5 billion, you're getting $1.60 of value for every $1 invested, a significant margin of safety. The specific calculations can become complex, involving terminal values, weighted average cost of capital, and scenario analysis. But the core principle remains: calculate what the business is truly worth, then only buy when you can pay significantly less. Common mistakes investors make. Understanding the $1 rule also means understanding how most investors violate it, often without realizing they're doing so. Mistake number 1: confusing price movement with value creation. Many investors buy stocks because they think the price will go up, without any analysis of underlying value. They're essentially gambling on market sentiment. This is speculation, not investing. I've seen countless investors during the cryptocurrency boom of 2021 buying assets at astronomical valuations, convinced that because the price had been rising, it would continue rising. They had no framework for calculating intrinsic value because many of these assets generated no cash flows. When the bubble popped, they lost 70%, 80%, even 90% of their investment. Mistake number 2: paying attention to short-term market fluctuations. If you've calculated that a business is worth $100 per share, it doesn't matter if the market temporarily prices it at $85 or $115. These fluctuations are noise. But most investors obsessively check their portfolio daily, reacting emotionally to meaningless price swings. Mistake number 3: ignoring the margin of safety. Some investors will calculate intrinsic value at $100, see a market price of $98 and call it a bargain. Buffett wouldn't touch it. The margin of safety is too thin. Accounting errors, changing business conditions, or multiple compression could easily turn that small discount into a loss. Buffett typically wants at least a 25 to 30% margin of safety, sometimes more. This cushion is what separates investors who preserve capital from those who suffer permanent losses. Mistake number 4: falling in love with the story instead of analyzing the numbers. A company might have an exciting narrative, revolutionary technology, charismatic founder, disruptive business model. But if the numbers don't support a valuation above the market price, Buffett walks away. Consider Tesla. Impressive company, transformative impact, visionary leadership. But Buffett has never invested. Why? Because at the valuations Tesla has commanded, he couldn't identify sufficient intrinsic value to justify the price. He might be wrong. Time will tell. But he's disciplined enough to stick to his principles. Mistake number 5: trying to time the market. Investors waste enormous energy trying to predict when the market will rise or fall. Buffett's approach is simpler. When you find value significantly exceeding price, you buy. When you don't, you wait. Market timing becomes irrelevant. Application beyond stock market investing. The genius of Buffett's $1 rule is that it extends far beyond stock market investing. This principle applies to virtually every financial decision you'll make. Real estate investment. Don't buy property because you think prices will rise. Calculate the present value of the rental income you'll receive, subtract all costs, and only purchase when you're getting more value than you're paying. The same principle applies whether you're buying a single-family rental or a commercial building. Business acquisition. If you're considering buying a business, calculate its cash flow generating ability, not just its revenue or assets. Many entrepreneurs overpay for acquisitions because they fall in love with top-line growth without analyzing whether the business generates actual cash that can be extracted. Personal development investments. Should you pursue an advanced degree? Apply the $1 rule. Calculate the present value of the incremental earnings the degree will generate over your career, subtract the cost of tuition and lost wages, and see if the value exceeds the price. For some degrees at some institutions, the answer is yes. For others, it's clearly no. Even major purchases like vehicles can benefit from this thinking. Don't buy a car based on monthly payment affordability. Calculate the total cost of ownership, purchase price, insurance, maintenance, fuel, depreciation, and compare it to the value you'll receive. Sometimes a more expensive, more reliable vehicle provides better value than a cheaper option. The $1 rule is ultimately about rational decision-making. It forces you to think clearly about value rather than being swayed by emotions, social pressure, or clever marketing. Building your own investment process. So how do you actually implement Buffett's $1 rule in your own investment decisions? Start by developing your circle of competence. What industries, business models, and company types do you genuinely understand? Be honest with yourself. Understanding means you can reasonably predict what the business will look like in 5–10 years. For most individual investors, this means focusing on simpler businesses with stable competitive positions. Consumer staples companies, established financial institutions, utilities, healthcare companies with patent-protected drugs. These are often easier to analyze than cutting-edge technology or biotechnology firms. Next, create a valuation checklist. Before investing in any company, require yourself to answer, what is this company's sustainable free cash flow? What is a reasonable growth rate based on historical performance and industry conditions? What discount rate should I apply given the company's risk profile? What is my margin of safety at the current price? If you can't confidently answer these questions, don't invest. It's that simple. Third, maintain an opportunity fund. Buffett keeps billions in cash at Berkshire Hathaway. Waiting for opportunities, you should maintain liquid reserves so that when the market offers genuine bargains, and it will periodically, you have the capital to act. Fourth, think in years, not days. Buffett's average holding period is essentially forever. He buys businesses he intends to own for decades. This long-term orientation completely changes how you evaluate opportunities and tolerate short-term volatility. Fifth, be willing to do nothing. Buffett has said that investing is one of the few fields where doing less often produces better results. If you can't find opportunities meeting your value criteria, the correct action is to wait. Patience is a competitive advantage that almost no one has. Warren Buffett's $1 rule is deceptively simple, yet most investors spend their entire careers never truly understanding it. The principle, only invest when you're getting more than $1 of value for every dollar you spend, seems obvious. But applying it with discipline requires analytical rigor, emotional control, and the courage to stand apart from the crowd. We've explored how this rule is grounded in mathematical reality through discounted cash flow analysis. We've seen it in action through Buffett's investment in Coca-Cola, which generated returns exceeding 1,900%. We've examined the psychological barriers that prevent most investors from following this principle, and we've discussed how to actually implement this approach in your own investment process. But here's what you need to understand. This isn't a get-rich-quick scheme. Buffett built his fortune over 70 years, not 70 days. The $1 rule produces superior returns through patient capital allocation and compounding, not through speculation or market timing. The beautiful irony is that in a world obsessed with complexity, algorithmic trading, cryptocurrency, derivatives, high-frequency strategies, the most successful investor in history relies on a principle that could be taught to a middle school student. Value investing doesn't require superior intelligence. It requires superior discipline. It requires the ability to calculate intrinsic value and the patience to wait until price falls below that value. It requires the courage to buy when others are fearful and the restraint to hold cash when others are greedy. Every investor faces the same question. Will you chase prices or pursue value? Will you follow the crowd or think independently? Will you react emotionally or calculate rationally? Buffett's $1 rule provides the framework to answer these questions correctly. It won't make you rich overnight, but applied consistently over decades, it's the most reliable path to building substantial wealth. The market will always offer opportunities to those who know how to identify value. Your job is to be ready, analytically, financially, and psychologically, when those opportunities appear. Remember, price is what you pay, value is what you get. The difference between the two is where fortunes are made. Start applying the $1 rule today. Build your circle of competence, calculate intrinsic value, demand a margin of safety, think long-term, and most importantly, be patient. The path to wealth isn't complicated, it's just rarely followed. If you found this valuable, implement one thing from this video in your next investment decision. And remember, the best investment you can make is in your own financial education. Keep learning, keep analyzing, and keep demanding value for every dollar you spend.